Today in the crypto education sphere, we'll be covering yield farming. Previously, I would say there's a prerequisite for this sort of video. You have to go through the liquidity pools video first. So if you go back a step, you'll see what are liquidity pools, and then once you've been through that, then we can sort of break down how liquidity pools interact and with yield farming and what yield farming really is. So what is yield farming, right? So yield farming lets you lock up funds, providing rewards in the process. It involves lending out crypto via DeFi protocols in order to earn fixed or variable interest. The rewards can be far greater than traditional investment, but higher rewards brings higher risk, especially in such a volatile market. As with most related to blockchain and cryptocurrencies, the concept of yield farming can be intimidating at first, but fear not, we're going to cover everything you need to know below. So yeah, we'll be covering a little bit on what the terms mean and sort of break it down for you. So yield farming in layman terms. At its core, yield farming is a process that allows cryptocurrency holders to lock up their holdings, which in turn provides them with rewards. More specifically, it's a process that lets you earn either fixed or variable interest by investing crypto in a DeFi marketplace. Simply put, yield farming involves lending cryptocurrencies via the Ethereum network, for example. When loans are made via banks using fiat money, the amount lent out is paid back with interest. With yield farming, the concept is the same. Cryptocurrencies that would otherwise be sitting in an exchange or in a wallet is lent out via DeFi protocols or locked into smart contracts in Ethereum terms in order to get a return. Yield farming is normally carried out using ERC20 tokens on Ethereum, with the rewards being a form of ERC20 token. Whilst this, so for example, if you lock up, let's say, ETH into Beefy Finance, then the token could be called Beefy. So you might be paid out in Beefy tokens. That's one example. So whilst this might change in the future, almost all current yield farming transactions take place in Ethereum ecosystem. But now we know that they take place on all other ecosystems, from Binance to Solana to AVAX, and we look for the best sort of places to get these. So yeah, the first step in yield farming involves adding funds to a liquidity pool, which are essentially smart contracts that contain funds. Those pools power a marketplace where users can exchange, borrow, or lend tokens. Once you've added your funds to a pool, you've officially become a liquidity provider. In return for locking up your funds in the pool, you'll be rewarded with fees generated from the underlying DeFi platform. Note that the investment in ETH itself, for example, does not count as yield farming. Instead, lending out ETH on a decentralized non-custodian marketplace protocol like Aave, then receiving rewards is yield farming. So yeah, so there's variables to this, right? So a quick summary of yield farming. Let's go through this real quick, and then we'll look through this video here as an interactive sort of experiment. But yeah, let's do a quick summary. Liquidity providers deposit funds into a liquidity pool. Deposited funds are normally stable coins linked to USD, such as DAI, USDT, USDC, and more. Another incentive to add funds to a pool could be to accumulate a token that's not on the open market or has no low volume by providing liquidity to a pool that rewards it. Your returns are based on the amount you invest and the rules that the protocol is based on. You can create complex chains of investments by reinvesting your reward tokens in other liquidity pools. So yeah, so a lot of these dexes, for example, or launchpads have multiple liquidity pools that you can play with. So what can you do with yield farming, right? So top yield farmers have earned as much as 100% on popular stablecoins using a whole host of different strategies. One strategy involves one of the most popular DeFi platforms, Compound. The platform rewards investors with comp tokens for both supplying and capital borrowings, and many users maximize their return by doing both. Borrowing funds on Compound provides comp tokens as a form of cashback. The more you borrow, the more comp tokens is provided. If the cashback is worth more than the cost of the borrowing fees, you can keep on borrowing to farm the cashback rewards. Because liquidity miners are compensated for both lending and borrowing, one strategy is to lend the highest interest rate assets, borrow as much as you can against the tokens, and then return the remaining assets back to the lending protocol. The potential end result is 100% APY instead of 0.01 to 1% that most banks offer, which is a very substantial increase. In-depth strategies are both scope of this article. So yeah, so this is a little understanding of yield farming. I'm gonna play a little video for you guys, just a couple of minutes from this fine magic thing, so you guys can understand it a bit deeper. So just give me a second.
Of these days, when it comes to yield farming, the returns can be pretty insane, with some of the strategies bringing as much as 100% APY. So how is that possible, and where is a catch? There are three main elements that make such returns possible: liquidity mining, leverage, and risk. Let's cover all of them before we jump into some common strategies. Liquidity mining is a process of distributing tokens to the users of a protocol. One of the first DeFi projects that introduced liquidity mining was Synthetics, that started rewarding users who helped with adding liquidity to the SETH pool on Uniswap with SNX tokens. Liquidity mining creates additional incentives for yield farmers, as the token rewards are added on top of the yield that is already generated by using a certain protocol. Depending on the protocol, these incentives may be so strong that farmers may actually be willing to lose on their initial capital just to get more rewards in the distributed tokens, which makes their overall strategy highly profitable. A good example of this was the liquidity mining of comp tokens introduced by Compound, that was initially giving higher rewards to the users who were borrowing assets with the highest APY. This incentivized farmers to start borrowing these assets, as the value of minted comp tokens was compensating them for the high borrow rates they had to pay. Comp liquidity mining got super popular and was pretty much a catalyst for a wider spread of yield farming. Besides liquidity mining, leverage is another element that makes ultra-high returns possible. Leverage is a strategy of using borrowed money to increase the potential return of an investment. In our yield farming world, farmers can deposit their coins as collateral to one of the lending protocols and borrow other coins. Now, they can use the borrowed coins as further collateral and borrow even more coins. By repeating the whole procedure, farmers can leverage their initial capital a few times over and start generating even greater returns on their initial capital. The last missing element of double or triple digit APYs is the high risk that farmers are willing to take. The first one is related to the previous thing that we just discussed, leverage. All the loans that farmers are taking are over-collateralized, and supplied collateral is susceptible for liquidation if the collateralization ratio drops below a certain threshold. Besides the liquidation risk, we have our standard smart contract risks like bugs, platform changes, admin keys, and systemic risks, for example, Ether sharply losing its value. On top of that, we have a few new attack vectors specific to DeFi, for example, attacks that aim at draining certain liquidity pools. All of these risks put together are yet another reason why yield farming returns are so lucrative. It's a high risk, high reward game. Yield farming strategies are sets of steps that aim at generating a high yield on the capital. These steps usually involve at least one of the following elements: lending, borrowing, supplying capital to liquidity pools, or staking LP tokens. Before we look at them one by one, if you already made it this far, hit the like button and don't forget.
So yeah, I hope that kind of gave you a little briefing of how liquidity pools work and how yield farming sort of base off the sort of different elements like mining and basically gives you a little insight of, you know, if you borrow, if you lend your tokens and earn an APY, then that's a good way of earning. And usually banks would, like, if you were to lock up your money in a bank on a savings account, the maximum you can get is 0.5 to 0.1 to 2% throughout the year. But here in yield farming, we're able to earn up to 100%, 200, 300% APR. So that's the difference, and I hope that kind of explains yield farming a little bit. So yeah, thank you guys. I hope that was helpful. Lightspeed.